Okay, let's unpack this.
Let's do it.
We are diving deep into a very specialized and honestly a hyper-accelerated corner of the Indian investment landscape.
Mm-hmm.
We're talking green energy mutual funds. Our sources give us this incredible snapshot of financial data and policy wins from the first half of FY 2025-26.
And it really paints a picture of, well, a massive and rapid acceleration.
There's more than just acceleration, though, isn't it? It feels like a real structural pivot.
Oh, absolutely. The data shows something remarkable. I mean, just between April and September of 2025, India added nearly 28 gigawatts of non-fossil fuel capacity.
28 GW.
That's
That's huge in
yeah.
just 6 months. And that's all clean power. Solar, wind, hydro.
All of it. Now compare that to the other side.
The older stuff, fossil fuels.
In that same period, only about 5.1 gigaBU of fossil fuel capacity came online.
So 28 to 5.
That ratio right there, that's the core story. It shows you where the capital, the effort, the entire direction of the country's energy plan is tilting.
And so our mission in this deep dive is to distill what's going on here. The characteristics of these funds, the huge opportunities, but also the very real non-negotiable risks.
Exactly.
So before we get into the specific funds, let's get a baseline. What exactly is a green energy mutual fund?
Fundamentally, they're equity mutual funds. So they pool investor money
Right.
to invest in companies that are involved in renewable energy. That could be component manufacturers, solar farm developers, wind turbine companies, you name it.
And critically, they're sectoral funds,
That's the key term.
which means they are laser-focused,
Yeah.
not tracking the broad market.
Exactly. They are taking an intense, concentrated bet on a single theme.
And that theme is the energy transition,
Right. And that's what separates them from, say, a traditional energy fund that's all oil and gas.
or even a broader thematic energy fund that might hold a bit of everything.
These are specifically aiming for that low-carbon shift.
Okay, so looking at the funds in our source material, we've got a list of the top players, ranked by their size.
By their AUM, yeah.
Asset under management. For anyone who doesn't know, that's just the total value of everything the fund manages.
And these are not small funds. The source lists 7 major ones under the energy and power category.
And the two at the top are huge.
They really are. The ICICI Prudential Energy Opportunities Fund is managing over 10,000 crore.
And the SBI Energy Opportunities Fund is right behind it with over 9,500 crore.
Huge pools of capital.
Okay, here's where it gets really interesting.
Mm-hmm.
Because the sheer size of these funds, it doesn't automatically mean they're 100% pure play clean energy, does it?
That is the vital insight. If you, as an investor, are prioritizing, say, pure ESG alignment,
Environmental, social, and governance.
you have to read the fine print. You have to look at the fund objective.
So what does the fine print say for the biggest one, the ICICI fund?
Well, its stated objective is to invest across the entire energy value chain.
The entire chain. So that means...
That means everything. Oil and gas, right through to renewables and power utilities, it's all in there.
So an investor might think they're betting on solar panels and find out they also own a piece of a traditional utility.
They absolutely might.
Why do they do that? Why adopt that kind of blended approach?
It's often a pragmatic strategy. By including those established sectors, the fund gets the benefit of their existing revenue, their infrastructure.
Their stability.
Exactly, their stability. They sort of act as a bridge. You blend the steady cash flows from the old energy world with the, explosive growth potential of the new one.
It's a way to ride the transition without being totally exposed to the volatility of brand new tech.
Precisely. You're betting on the whole system transitioning, not just one piece of it.
That makes a lot of sense. And we see other flavors, I guess, in the data too.
Oh, for sure. Look at the DSP Natural Resources and New Energy Fund.
Okay.
It's a different kind of hybrid. It combines natural resource companies, think metals, mining.
The stuff you need to build the green tech.
The raw materials, exactly. It holds those alongside the companies developing the clean energy tech itself. It's a bet on the whole supply chain.
And then there's something like the Nippon India Power and Infra Fund.
Right, and their focus is more on the physical architecture. The grid, transmission lines, modernization, the infrastructure that makes it all work.
So the takeaway for you, the listener, is that green energy isn't a single thing.
Not at all. It can mean pure play solar, or it can mean a broad investment in materials, utilities, even the traditional energy players helping to fund the shift.
You have to check that fund objective.
It is the absolute first step.
Okay, let's pivot to what's driving all this. The policy environment. That 28 GW number is astonishing.
It is.
If we connect this to the bigger picture, this isn't happening by accident. This is a massive national project.
It's a huge success story for policy. I mean, the sheer volume is staggering. The sources tell us that within the non-fossil mix we already have, solar alone is about 127 GW.
Wow.
And wind is over 53 GW. That's the foundation they're now building on, and fast.
But there's one number that I think tells the whole story. The one that explains why global capital is flowing in.
The national capacity target.
Mhm.
India's total power capacity crossed the 500 GW mark in September 2025.
A huge landmark.
But here's the critical part. Over 51% of that total capacity now comes from non-fossil sources.
51%. That was the goal from COP26, wasn't it?
It was, and they hit it 5 years early.
5 years ahead of schedule.
That kind of achievement sends a massive signal to the markets. It says the policy push is real, it's deliverable, and it creates this incredibly favorable tailwind for investment and innovation.
And as you said earlier, even though these are concentrated funds, you get diversification within the theme.
You do. It's not just a bet on solar versus wind.
Right.
You get exposure to hydro, but also to emerging tech, green hydrogen, advanced battery storage, smart grids. You're investing in the whole infrastructure of the future.
Okay, that brings us to the counterpoint. High growth, new technology, government dependency. That always comes with risk.
Always.
So what does this all mean for someone being cautious? Let's talk about the challenges.
Well, the number one risk is what we've been talking about. Sector concentration risk.
Because you're all in on one basket.
You're all in. If that sector has a downturn, maybe the price of solar components spikes globally, or there's a policy change at home, the impact on your fund is magnified. There's no buffer from the IT sector or consumer goods to soften the blow.
And that concentration makes them extremely vulnerable to political decisions.
Absolutely. That's the second big one, policy and regulatory risk. This sector lives and breathes government support.
Subsidies, tax breaks.
Exactly. Changes to import duties, tweaks to power purchase agreements, a reduction in subsidies. Any of that can directly and very quickly hit the profitability of the companies in these funds.
Okay, let's go deeper on technology and execution risk, the newness factor. It's not just about things breaking, is it?
No, it's about the pace of change and, frankly, just getting things built. On the execution side, big renewable projects often have cost overruns or delays.
We see that all the time.
It happens. And that immediately hurts the developer's balance sheet. Then you have the tech side, where innovation is just so fast. A fund might be heavily invested in one type of battery tech today.
And 6 months later, something cheaper and better comes along.
And suddenly their holdings look obsolete. You're betting on a moving target.
And just general market forces still apply. The volatility figures in the data looked pretty high.
They did. That's market volatility. These stocks are very sensitive to things like interest rates, which make big projects more expensive, and global commodity prices, lithium, polysilicon, those can cause wild swings.
I think the SPI fund was listed with a volatility of around 17.5.
It was 17.46, and that's a number you as an investor have to be comfortable with.
We have to touch on taxes.
Well,
The numbers in our source looked a little different from the standard equity fund rules.
that's a crucial point of clarification. For most equity funds in India, the rule is pretty standard.
Short-term gains under a year are taxed at 15%.
Right, and long-term, over a year, are taxed at 10% on gains over 1 lakh.
But the source cited 20% and 12.5%.
It did, and that's a huge signal for you to check the fund's official classification. If it holds a lot of non-equity assets, maybe infrastructure bonds as part of its strategy, it could fall under different tax rules, like for hybrid or debt funds.
So the lesson is, don't assume. Always check the official fund document.
Always.
Okay, let's bring this all together. Let's talk application. The sources, of course, don't give advice, but they offer a great checklist for how to think about this.
This is all about critical thinking. Number 1 on that checklist has to be the fund objective.
We've said it before, but it's that important.
It is. You have to match the fund's actual focus. Is it pure renewables? Is it resources? Is it the whole energy system with your own personal goals?
Don't just get drawn in by the word green.
Exactly.
And with a huge regulatory risk, what's the action item for an investor?
You have to stay informed. Treat this like any highly regulated industry. You need to know what the government's next 5-year plan is, what new incentive schemes are coming. Those things directly impact your returns.
The third thing is just being honest with yourself, right? About your own risk appetite.
Precisely. You have to align the fund's volatility, that 17.46 number, with your own risk profile. Can you handle a big drop if the sector hits a bump?
And finally, you have to watch the trends.
You do. Monitor the market trends and demand. The sector is moving so fast. Is the fund you're looking at positioned for the next wave, like hydrogen, or is it maybe overinvested in older tech?
Just for context, our sources did note the top performers over the last year,
Mm-hmm. The ICICI Fund, the DSP Fund, and the Tata Resources and Energy Fund.
which seems to show that, at least recently, that blended strategy of covering resources, traditional power, and new energy has been pretty effective.
It does. It suggests the winners so far have been the ones betting on the entire ecosystem of the shift, not just the shiniest new object.
So to recap, green energy mutual funds in India. They offer this direct, high-potential way to invest in a massive, successful, clean power transition.
A transition that's underpinned by some serious policy wins, like hitting that 50% non-fossil goal years ahead of schedule.
But that potential comes with very specific, concentrated risks.
And this raises an important question for you to think about as you look into this space. We've talked about the tension between pure ESG investing and a more pragmatic approach. Given that some of the biggest and best performing green funds still hold traditional oil and gas assets, how do you personally weigh that trade-off? Is the stability and the revenue from the old energy system, which, let's be honest, helps pay for the transition, is that worth compromising on a pure play sustainable portfolio? That nuance, that tension between financial pragmatism and ethical purity, that's the crucial question you have to answer for yourself in this market.